Good morning. In this chapter 11, we're going to focus on accounts receivable, primarily focusing on our risk assessment, understanding the test of controls, and our substantive procedures. Let's talk about the risks associated with accounts receivable. We're primarily concerned with the overstatement of accounts receivable. This may be tied with an overstatement of revenue. There may be complex accounting rules associated with revenue, or give the opportunity for an organization to overstate revenue, therefore overstating the accounts receivable. In addition, as we are looking at our net accounts receivable, we're concerned that the accounts receivable is valued appropriately. When we talk about valuation related to accounts receivable, we have to take into account how the organization is valuing the allowance for doubtful account. Let's talk about the management assertions associated with accounts receivable. We need to determine that the accounts receivables occurred related to specific revenue transactions. We need to establish the completeness of accounts receivable and tie this with the revenue transactions. We need to verify the cutoff of revenue transactions and ascertain that these accounts receivable are reported in the correct period. We need to determine that the client has the rights to the recorded receivables. It's possible that these receivables were sold or what we call factored. In many cases, an organization will sell accounts receivable so they can gain access to the cash from accounts receivable. We need to determine the accuracy and the valuation. Again, as we talked about before, this includes an assessment of the allowance for doubtful account, and then finally determine that the presentation and disclosures for accounts receivable are appropriate. Let's talk about specific control issues related to accounts receivable and revenue. Now, keep in mind that the control environment comments that we make here really apply to everything that we're talking about related to the financial statement. It's important that there is a commitment to integrity and ethical behavior from top management. There needs to be independence of the board of directors as well as the audit committee. There needs to be appropriate structure and line of responsibility, including the commitment to recruit, develop, and retain competent employees. Employees need to be held responsible. Now, when we're talking about the inherent risk associated with accounts receivable, we need to understand the inherent risk related to certain revenue transactions where the revenue is reported based upon highly complex accounting rules. These accounting rules create a risk, an inherent risk that we need to incorporate in the assessment of accounts receivable. Part of our assessment of internal controls is the observation and understanding of specific steps in the revenue process. There needs to be controls specifically related to the preparation of a sales order. This includes the approving of credit. The sales department should not be responsible for entering or changing the customer information, nor responsible for approving credit. The issuing of merchandise from stock needs to be controlled and separated from the sales department, as well as shipping, billing, and invoice verification. If there are questions coming from customers, these questions related to these invoices should go to someone other than the person that is sending the invoices. There needs to be a control related to the control accounts, including the customer ledgers, as well as maintaining the customer listing. The customer account information should be secured. The approval for sales and returns and allowances is critical. It's critical to control this, and in fact, returns and allowances is an area where there is a significant fraud risk. The authorization of write-offs of uncollectible accounts should not be done by accounts receivable. It generally is done outside the finance department and is completed by the treasurer of the organization. Finally, as an auditor, we need to understand what management is doing on a regular basis in terms of monitoring these controls. The effectiveness of these controls will only be known if these controls are monitored. Given that accounts receivable ties directly into the revenue cycle, It's important that we understand and actually test revenue at the same time that we're testing accounts receivable. So what are we looking for in the revenue cycle? Well, first we're looking for a customer purchase order. We're also wanting to see a sales order. The sales order is being generated by our client. We want to understand that the item was actually shipped. We're looking for a bill of lading. Finally, we need to understand that the item was billed. We then need to understand that there was a cash receipt, that it was posted to the appropriate account, and that any adjustments, credit memos, returns, and otherwise are accounted for and authorized appropriately. As part of our assessment of accounts receivable and revenue, we need to understand that fraud risks exist. To assess fraud risk, we need to understand the controls that management has put in place. We need to understand not only are they there, but are they working effectively? As we talked about before, we're also interested in understanding what management is doing in terms of assessing the risk. There are specific risk elements related to accounts receivable and revenue, some of which are related to occupational fraud. Perhaps an individual within the organization is stealing cash, taking cash that should be posted to accounts receivable. This is one of the reasons why understanding effective controls over credit allowances and write-offs are so critical. The other element related to fraud that we need to understand is the fraud that occurs from management, as management may be interested in manipulating the financial statement by overstating revenue. Let's talk about specific tests of controls that need to be a part of our audit. We need to examine several aspects of sales transactions, such as comparing a sample of shipping documents related to sales invoices, making sure that everything that was shipped was actually sold. We need to review the use of authorization for credit memorandums as well as write-offs. We need to reconcile cash register tapes with sales tickets in the sales journal to make sure that revenue is complete. We need to understand IT application controls. Given the fact that most transactions are completed in an IT environment, we need to understand access controls related to specific elements. As an example, entering customer information. This should not be done by the sales department. Changing sales information, changing data for customers should not be done by the sales department. We need to understand who gives the authorization for credit approval. We need to understand the access for adjustments, for credits, as well as write-offs. Every one of these transactions within the IT environment should be set up in such a way that it can be audited. It's very interesting in the sense that most ERP systems now allow an auditor to go in and see where any change has taken place, understand who actually did that change, and based upon that assessment, we are actually able to determine if the appropriate controls are in place, in this case related to accounts receivable and sales transactions. Let's now talk about our substantive testing that we're going to be doing related to revenue as well as accounts receivable. Keep in mind that with substantive testing, we are measuring monetary misstatement. Some of the things that we're going to be doing related to measuring accounts receivable is a confirmation. We'll talk about confirmations in the next slide. Confirmations is where we go directly to the customer to confirm account balances. We want to review transactions for unusual or large transactions. We need to compare and consider valuation specifically related to accounts receivable as well as notes receivable. We need to understand how management has established estimates related to revenue recognition as well as accounts receivable. And then finally, we need to understand the revenue recognition guidelines. And this is especially the case when there are complex rules associated with the recognition of revenue. The primary substantive testing related to accounts receivable is a confirmation. This is a confirmation of accounts receivable. Now, if we go back to the audit risk model that we've talked about in the past, we as the auditor control detection risk. We control detection risk through the nature, timing, and extent of our audit testing. The confirmation type is an example of the nature of the testing. We use a positive confirmation when the risk is high. We use a negative confirmation where there is a low risk associated with accounts receivable. So let's talk specifically about what a confirmation is and how the positive and negative confirmation differ. In a confirmation, the client will send a letter to the customer requesting that the customer confirms the accounts receivable balance as of a specific date. The confirmation goes directly to, in a positive confirmation, the customer will confirm the account balance and will send the letter back to the auditor. In a negative confirmation, the only time we expect to see a letter or comment from the customer is if the account balance is different than what is stated on the financial record. Keep in mind that once we get this information back, the auditor will then need to reconcile any differences. Potentially the differences will be associated with the timing difference of specific payments. To complete our valuation assessment of accounts receivable, we need to gain an understanding of the allowance for doubtful account. The primary way that we assess the allowance for doubtful account is using data analytics. Primarily, what we would do is an aging report on our accounts receivable balance. We would assess these balances based upon the amount 0 to 30 days, 30 to 60, 60 to 90, and so forth. We'd also identify older accounts and determine if possibly these accounts should actually be written off. Based upon our assessment, we would then compare this to what the organization has set up as their allowance for doubtful account and determine if the balances are reasonably stated. This concludes our lecture related to accounts receivable. I look forward to our next discussion.